Hey guys, Jerry Freeman here. Welcome back to my Amazon accounting video series. I just want to preface the next part in the series with some basic accounting concepts. Some of you may have heard of the cash method of accounting and the accrual method of accounting. When you first started your business, you may not have understood what the implications of choosing one over the other were, or what they even meant. And I'm here to explain the basics to you, and hopefully you can utilize this knowledge and information and apply it to your business. And if you're in the Amazon industry, you will have a better understanding of how it pertains to recognizing your Amazon activity. And just as a side note, this preface with cash versus accrual applies to any business. It's not unique to Amazon businesses. But the overall concept is that the cash method of accounting is when you recognize sales and expenses based on cash coming in or leaving the company's bank account. So just to give you a simple example, if your customer sent you $100,000 on February 5th, you would recognize $100,000 in sales on February 5th. If you paid January and February's rent on February 5th, let's assume it's $2,500 each month, so you paid $5,000 on February 5th, your rent expense in February will be $5,000. So some of you may have understood what the issue with that is already just from the way I'm explaining it to you. It essentially, when you look at your financial statements, you're going to see rent expense of $5,000 in February, and you're going to see sales of $100,000 in February, even though that customer payment may have been for various transactions that occurred in January as well. So enter the accrual method of accounting to solve this problem. Essentially, with the accrual method of accounting, you recognize sales when they are earned and you recognize expenses when they are incurred. So it has nothing to do when the cash is coming or leaving your company's bank account. It is strictly based on when things are earned and incurred. So in this example, if $50,000 of that $100,000 payment on February 5th related to January, you would have $50,000 in January and $50,000 in February, broken out over both months to more accurately reflect when the sales actually occurred. On the expense side, you would have $2,500 rent in January, $2,500 rent in February. Now, you may ask me, well, what about the cash side of the transaction? How does that work? Well, the answer is simple, is that when you're booking that sale in January for $50,000 under the accrual method of accounting, you're going to be hitting your accounts receivable account. So you're going to have an increase in sales of $50,000, an increase in your accounts receivable of $50,000. Then when your customer pays in February, you would essentially be reducing the accounts receivable balance from January and increasing your cash. And same thing with the expense. So if you had rent expense in January, $2,500, so when you pay that expense in February, you would basically be reducing your accounts payable of $2,500 and increasing your rent expense for February, but you wouldn't be touching rent expense for January. So that's the overall concept. If any of you have any questions, if things are not clear, please feel free to reach out. That's a very, very basic overview. Now on to our example with our Amazon business. We're going to continue with the similar example as we've used in the past. Here is where we left off from last example. In the prior two videos, we discussed about grossing up Amazon sales and recording refunds and returns and Amazon fees correctly. We also discussed about some of the balance sheet accounts and recording those correctly, like sales tax payable and Amazon term loans. So this is where we left off. Now, when you take a look at this, what I see is $115,000 in March of sales and additional expenses in the same month. But if you receive this at the beginning of March, this is including activity that had occurred during February. So when I'm looking at my financial statements right now, this is not an accurate depiction of the activity over February and March. So it has to be done, and this is where the accrual method of accounting comes in. Things have to be broken out properly. So just as a quick reminder, under the accrual method of accounting, revenues are recognized when earned and expenses are recognized when incurred, regardless of when the cash is received or paid. Now here's how things should look based on the accrual method of accounting. So I added in a column for I added in a column for February. I also added in some new accounts here, which I will explain. So in reality, these $115,000 in sales and all these returns and refunds and Amazon fees are now broken out correctly over the month when the activity actually occurred. So when the revenue was earned, when the expenses were incurred. So now we had $75,000 in Amazon sales income in February and $40,000 in March, totaling $115,000, and so on and so forth. As you can see with Amazon returns and refunds, and so as with the Amazon fees as well. So you may ask, well, how does it work if no cash came in and went? What's the other side of this entry? And that's where these accounts come in here. So I created an accounts receivable account and I created Amazon fees payable. So since we did not yet receive the cash, if you look at your balance sheet at the end of February, you should have this $75,000 in accounts receivable. And same thing here, all these fees have to be accrued for, because remember, even though you didn't pay those fees yet to Amazon, you still have to accrue for them because they were incurred. So that's why we created this Amazon fees payable. What some people do is they would just net this and this together, so your accounts receivable would show a net effect of $65,000, which is not terrible, but again, this is just an accurate depiction of your business. So now imagine looking at financial statements for the entire year. You are truly able to see the activity that occurred over that given period in time. You're able to see how your sales fared in a specific month. You're able to see your various fees, and you know, there's many implications and many benefits to doing it this way. I mean, just taking a look at these accounts here, you can compare things month over month, and you can identify if February was higher, why was it higher? And obviously over here with this example, we're not going to get that granular because this is these numbers are fictitious, are fictional. But when you actually have real numbers you're working off of, it's super important. And I actually just had this with a client of mine where his expense that increased dramatically, and he wasn't recording things correctly like I'm showing you here. And once we had broken things out properly, we were able to identify why they increased. He had a much higher storage fee for that month, and it turns out that it was because he was storing a much larger item in Amazon's warehouses, and his fees went up tremendously. But the overall point and gist is that when you look at your financial statements, you have a very good understanding of what occurred. You can do trend analysis, and you can plan for the future. That's all for this video. Please feel free to reach out if you have any questions. If you have any feedback, if you disagree with anything I said, feel free to hit the comments or send me a DM. Thank you very much.